2.5 years, when the world as a whole had been impacted by COVID-19 pandemic situation. But even otherwise, if you look back 2 or 3 decades, there have been some very, very significant changes which have taken place in this world, which have changed the way we live our life and also changed the way the businesses function in the marketplace. It's a very different world today. If you compare it with the decade of 90s, or maybe if you go back to early 80s, it's very, very different in terms of the way we live our life and also the way the businesses function in the marketplace. Today, what we say is that it's a VUCA world, which is highly vulnerable, very uncertain, hugely complex, and very, very ambiguous. And the kind of competition that we have in the marketplace and the expectations which are changing and increasing every moment, it's a hyper competitive, very, very complex business and economic environment, coupled with the fear of uncertainty at the back of our mind. We really know what's going to happen the next quarter, the next 6 months, the next year. And in these very, very dynamic business and economic conditions, the businesses across the world are finding it challenging, at the same time, of course, exciting and interesting to be in a business arena in the 21st century. What we are also finding in the marketplace is that besides some gold-plated old age companies which have survived through decades, some of the companies which have survived through centuries, they're still existing, going strong. At the same time, we have quite a good number of new age startup companies which are mushrooming all across the world, including that in India. And some of these new age companies, even some of the old gold-plated companies which have sustained over a period of time, they are now looking at and building up some very, very innovative and disruptive business models. Let's look at some examples. World's largest travel car company does not own a single car of its own. That's Uber. Look at the business model. World's largest travel lodging company does not own a single hotel property of their own. That's Airbnb, similar to the model of Oyo also. World's largest retailer, Amazon, does not own a single brick and mortar store. That's Amazon. It's very, very disruptive business models that we are looking at, which were unheard of till about a few decades back. But these are the realities of the corporate world in 21st century. Very, very disruptive and amazingly exciting business models that we are looking at. But let's continue our discussion on the new age startup companies. India today is having a third largest ecosystem of startups in the world. And we also have over 150 unicorns. A unicorn is a company which has valuations exceeding $1 billion US. And we have more than 115, and the number is growing week by week, fortnight by fortnight, month by month. But what is interesting to note is that out of these over 115 unicorns that we have in India, and if you look at the top 10 unicorns of India, only 3 of them are making profit. Rest 7 of them in the top 10 list are making losses. But look at their valuations, the way they are skyrocketing, the way they are soaring in the marketplace. And that's what we are going to discuss today. What is this valuation all about? how and why it is important for the corporates as well as the entire business and economic world. Because we also find that in the marketplace, there are many businesses today which have profitless turnover. They have a great top line, but end of the day, there is no profit. And many businesses have cashless profit. They have accounting profit as per profit and loss account, but there's no cash, there's no liquidity. Profitless turnover, cashless profit. But when you look at valuation of some of these businesses, wow, soaring very, very high. Because today, what the stakeholders essentially are looking at is a business which has ability to create value, which has ability to be able to preserve that value, and ability to enhance that value going forward on a sustainable basis. That is what the stakeholders are looking for and expecting from the company. Credible valuations are very, very vital for efficient functioning of the capital market, the business world, and even for the government and all the various other stakeholders. If the valuations are not correct, investment decisions would not be optimum, and the funds may get channelized and diverted into businesses, into assets, which are probably not optimally allocated, and thus the resultant outcome in terms of returns that the stakeholders may get by way of investment from a particular business or an asset may not be satisfactory, may not be as per the expectations. Valuation is the process of determining economic worth of an asset. We are trying to look at what is the economic worth of any business, any asset. And because we are looking at identifying the worth of the business going forward, obviously we have to depend upon certain and various assumptions. And the kind of data that we are looking for carrying out valuation is also going to be a challenge, both in terms of quantity and quality. And then the valuation of a business is done as on a particular date. That's very, very important to understand. Just as you prepare the balance sheet of a company on 31st of March and look at the position of assets and liabilities, if you were to draw the balance sheet of the same company on 30th of March or 1st of April, the position of assets and liabilities will be different. Similarly here, the valuation of any business or an asset is carried out as on a particular date. So valuation is important for any transaction to take place. That's because from the buyer's perspective, it should give them an idea how much should be the optimum price to pay for a business or an asset. And similarly, from the perspective of the sellers, they ought to know what is the price that they can fetch by selling an asset or transferring ownership of a business or asset at a given point of time. So business valuation is essentially an independent appraisal of the economic worth of a business. That's just a broad perspective. I'm now going to get into details, trying to explain and share with you my perspectives on what exactly valuation is and how it leads to creation, preservation, and enhancement and sustenance of the value for a company. The measures of corporate performance in 21st century have undergone a change. Of course, you look at profit. Profit is important with a view to ensuring going concern status and sustainability of a business. But the change that has been brought about is that the path to profit now passes through people and planet and the broader matrix of value. Stakeholders would like to get themselves associated with companies which have the ability to be able to create value, preserve value, and enhance value. And once you focus on building value for the stakeholders, valuations will automatically follow. So let's get down to brass tacks and understand what is value and how can we determine the same. I think these are the three keywords that we have there on the screen: price, cost, and the value. What is value? Value lies in the eyes of the beholder. Because valuation is the process of carrying out and finding out economic worth of a business or an asset, and that value obviously lies in future. Therefore, any two valuers given the task of carrying out valuation of any business or an asset are most likely to come out with two different estimates of valuation. That's because valuation is not only about numbers. It cannot only be mathematically derived by looking at the financial numbers of the company. But the valuation ultimately depends upon a lot of other factors which are beyond numbers, as well as it also depends upon the kind of assumptions that you make, the judgment of the valuation professional, his gut feeling, and there's definitely a lot of subjectivity involved in the whole process of arriving at the estimate of value for business or an asset. So valuation differs from person to person. Of course, it's likely to be within a given range. The valuation estimate will not vary significantly. It doesn't happen most of the times. But nonetheless, to expect that two valuation professionals will give you the same number, the same estimate of value of the business or an asset, that's not likely to be the case. That doesn't really happen. How do you determine the price in a transaction? You go to a market to buy any product, and the seller or the shopkeeper says, "Sir, 100 rupees for this." 100 rupees for any one of us in today's times, not a big deal. But still, we will not take out our wallet and straight away pay 100 rupees and get out of the shop immediately. We don't do that. We would like to haggle, negotiate. Baba, 100 is too much. 80 should be good enough. Now, what is the final price that you would end up paying for acquiring that particular product is going to be depending upon the comparative negotiating powers of buyer and the seller. But the point is that price or the transaction price of any asset, whether it is a 100 rupee deal or a 100 crore rupees deal, it ultimately depends upon and is decided by the negotiation between the two parties. That's how the price is actually set in any transaction. Coming to the cost factor, cost is directly related to creation of an asset. And for the creation of an asset, you will have to perform various activities. And all these activities are going to ultimately consume resources. And we can associate cost with those resources and thus find out what is the cost of creation of a particular asset or creation of a particular business at any given point of time. Now, why that is important? Both from the perspective of the buyer and the seller. Suppose you're looking at buying a particular ready-made house, and the seller says he wants to sell that to you for rupees 3 crores. There is a meeting which is going to happen next week, And you want to know, Baba, if I want to construct a house at this location today of the same quality, same design, how much is likely to be the cost which I will have to incur? So you may engage an engineer, you may engage an architect, and probably they'll be able to give you some rough approximate, reasonably okay number as to what is likely to be the cost of constructing a similar house at this location today. And suppose that number is 2 crore 70 lakhs. Now you have good enough information and you are confident enough to go for a negotiation meeting with the seller next week. He is asking for 3 crores, and you know from your own sources that the cost of construction of this house today is going to be around 2 crores 70 lakhs, and rest is only a matter of negotiation between the two parties. From the seller's perspective, obviously, a seller would not like to sell any product below the cost price. Whatever cost you would have incurred to create an asset or create a business, the seller would like to sell the product or business over and above that cost price, over and above that basic price or the cost that he would have incurred in creation of the asset. So cost is also an important matter to consider in all kinds of transactions, all kinds of business deals. And then when it comes to valuation, as I said, value lies in the eyes of the buyer. Value is the function of future benefits. What has been the value generated by a business or an asset in the past is not relevant anymore. If someone is getting into a deal today, what he's looking at is what is the value that he's likely to derive out of this business which is going to acquire today. And that's where you're looking for future economic benefits likely to accrue, likely to arise by acquiring a business asset today. Suppose there is a stock which has gained 80% over the last 6 months, and you've been only watching, you did not get into it. But now probably you may decide to get into that stock and want to buy that stock today when the price has already appreciated by 80% over the last 6 months. Why? Because you are expecting the price to go up still further higher in future period, and that's the motivation, that is the incentive why you want to get into that particular stock at this point of time. Because you still find the stock to be, if not undervalued, rightly valued, even at this point of time, because you are expecting the stock price to go further up higher. And therefore, valuation is all about looking at the potential economic benefits that are likely to arise by acquiring an asset today at a given price, at a given value. But then what is price? Price is what you pay. Value is what you get. Price and value are not the same. You acquire an asset by paying a price, but then you acquired that asset for the economic objective fulfillment of getting value out of that at a subsequent point of time. So how much price would you pay for an asset? It has no direct correlation with the value. It has some relation, yes, but no direct correlation with the value that is likely to be derived by acquiring an asset. There is a well-known phenomenon of water diamond paradox. What is the cost of a water bottle? 20 rupees, 30 rupees, 50 rupees, at some places 100 rupees, 150, whatever. But look at the value of the water. 2 drops of water can save a life. And water bottle costing peanuts, even if it is 150 rupees for a liter, 200 rupees for a liter, look at the value. Price is just nothing. But when you look at the diamonds, well, the price is very, very high, and value, well, I don't know. End of the day, it's just a stone. Of course, it has snob appeal, it has ostentatious value, but nonetheless, end of the day, it's just a stone. Price is what you pay, value is what you get, and thus the valuation depends upon price, of course, but still there's no direct correlation or proportional correlation between the two for that matter. That's why we say always try to acquire a business which is a wonderful business at a fair price. Don't acquire a business which is fair at a wonderful price. You must look at how much you are shelling out, how much you are paying out as of now, and what is the likely value that you are going to derive or going to generate by acquiring that asset at a given point of time. If there is a mismatch and a huge mismatch between the two, it's ultimately going to hurt you. That's what happened in the case of Tata Chorus mergers and acquisition deal of 2007. Tatas were scouting around in Europe for a new company to acquire as they were looking for expanding their footprints in the European market. And after about 6 months, 8 months of market survey, they finally zeroed in on a company, Chorus Steel of UK, and that was the company that they wanted to acquire. Tata Steel is a very big company of India, huge turnover, huge capacity, huge number of employees work there. But believe me, at that point of time, Chorus Steel UK was 4 times bigger than that of Tata Steel. And thus this was a case of reverse merger. Normally, a larger company acquires a smaller company, but when a smaller company acquires a larger company, it is technically referred to as a case of reverse merger. The deal was almost through, and Tata had offered a particular price for acquiring the shares of Chorus Steel Limited, for acquiring the entire business. It was all share purchase deal. Suddenly, what happened that a Brazilian company jumped into the fray and they offered a higher price to Chorus Steel for acquiring their shareholding. Tata had spent a lot of time doing market research, scouting around for a new company, had done a lot of discussions with this company. They also did not want to let go this opportunity. They also hiked their offer. Brazilian company also increased its offer price. Finally, Tatas were able to close the deal at a price which was almost about 40% higher than their original bid price. They did acquire Chorus Steel Limited, yes, for sure. But they ended up paying a price which was 40% higher than the original bid at which they had proposed to acquire Chorus Steel Limited. And we know that ever since Tata Steel acquired Chorus Steel of UK, the valuations and the performance of Tata Steel has never really looked up. It's been a bad deal for Tatas, not because the asset was bad, but probably because they ended up paying higher than reasonable price, the kind of value that they were expecting to get out of this deal, but they paid a little higher price, 40% higher than their original bid, and that's where ultimately it became a pain point for Tata. Now, Tatas are looking for divesting this particular business. They don't want to keep on holding on to this business anymore in UK. But the company is so big, they're not able to find one single buyer who probably would be willing to buy the entire company. Now they are coming up with a strategy of selling the business in parts. I mean, the whole process is still going on. But the point that I want to emphasize here is price is important point in a transaction for acquiring any business or any asset. But end of the day, price is that's what you pay in the first instance. But thereafter, value is what you expect to derive or generate from that business or valuation asset going forward in future. So you got to be careful what is the price finally that you end up paying for acquiring a business or an asset. So the price the cost and the value. Price is determined through the process of negotiation. Cost is the cost of creation of business, cost of creation of an asset, which involves performance of a lot of activities. And each activity is going to consume certain resources, and there are going to be costs associated with consumption of resources. That's how cost becomes relevant. And then you have the value, which is the potential economic future benefits which are likely to arise or likely to accrue by acquiring a business or an asset at a given point of time. That's the value that we have as the third element. So the challenge of valuation is the challenge of integrating value, price, and cost. That is the balance, the ultimate delicate balance in the whole equation, which will provide you and which will provide to the economy and the system a rational architecture of transactions where the assets get sold out and someone buys those assets, and it also provide you an optimum reasonable pricing of the same for the ultimate benefit of the economy and the capital market, whatever be the case. So what is valuation? Valuation is the process of finding out value of an asset or a business at a given point of time. There could be two different premises that you have at the back of your mind when you decide to value a business. One, going concern. That is the assumption and the premise that the business is likely to be able to continue as a going concern in the market, at least for a foreseeable future period of time. That's one premise. And the other premise could be that the company will not be able to sustain in the marketplace as a going concern going forward, and that premise is called the liquidation premise. If the business is likely to continue in the market as a going concern, then of course you can anticipate the future of the business by way of realistic scientific forecasts based upon the kind of data that you have available with you at this point of time. You can work out the future cash flows of the company. You can work out the way the turnover is going to increase and things like that. So we have one set of approaches in valuation, which we apply for valuation of a business on a going concern basis. But there could be a situation where it is found that, unfortunately, technology has changed, competition has increased, government policies have changed. Nothing is there in the business so as to warrant its continuation in the market as a going concern. There's no other way out but that the company has to be sent into liquidation. And what happens in liquidation is all the assets of the company are going to be sold out, cash will be realized, and then cash will be paid out to various claimants as per the priority order. And that's how the company gets wound up and the company gets liquidated. In order to sell the assets, probably you can follow a slump sale approach. One parcel, you sell all the assets of the company in one go, one point of time, or probably you can follow a piecemeal approach, selling part of the assets now, part of the assets sometime later. Obviously, the second approach, the piecemeal approach, is going to provide you better value for the assets because you are selective in selling assets at different points of time and you are waiting for the right price or the right value. You'll be able to fetch a better price by selling on a piecemeal basis. But the two basic premises that we have in valuation, valuing a business as a going concern or valuing a business as a liquidation or as a liquidating entity, the two different assumptions, two different premises that may be followed for estimating the potential worth of a business or an entity at a given point of time. So just to reiterate, Valuation is monetary worth of future benefits one is likely to have or going to have from an asset to be acquired today. That's what valuation is all about. Value depends upon who is determining the value and for what purpose. Valuation is required in very many different situations. In case of split of a joint Hindu undivided family, where the descendants are looking for their individual shares, valuation of HUF property will have to be carried out. When you are looking at a partnership firm, at the time of admission of a new partner, you have to recast the profit sharing ratio. Or when a partner ceases to be a partner in a partnership firm, even at that point of time, you got to carry out valuation. And also, if the partnership firm is getting dissolved, investors, of course, carefully look at the value of a stock before they decide to commit their money or put their money in a particular share in the stock market. They carefully evaluate and look at the value of each stock. Buyers and sellers obviously are interested in finding out the value of any asset from their own beneficial perspective. The seller would like to know the value, and the buyer also would like to know the approximate value. And then, of course, they can both sit down together, negotiate a particular transaction price for entering into a contract or a transaction between the two parties. Many of the companies in the marketplace also offer ESOPs, employee stock option in place of cash bonus or cash increment. They tend to offer ESOPs to their employees. At the time of issue of ESOPs, again, the shares are going to be given free of cost to the particular employees, but a notional value of each share is required to be worked out as per the formula guided by, as per guidelines of SEBI. And again, that's where the valuation becomes very, very important. So value of any asset depends upon who is determining the value and what is the purpose or objective of carrying out the value at a given point of time. So value depends upon who is doing valuation, why valuation, and the third critical element is the timing when one is doing valuation. If you look at the valuation of any company and compare that with your pre-COVID valuation and today's valuation, there's going to be a significant variance in the valuation of that company, either on the upside or on the downside, depending upon which sector the company belongs to and what had been the impact of COVID-19 pandemic. COVID-19 impacted various businesses differently. It positively impacted some businesses and it negatively impacted most of the businesses. So which sector you are operating in, that's going to determine whether there's going to be an upside or a downside, but nonetheless, the pre-COVID valuation and as compared to valuation of the same business today is going to be significantly different because of the timing difference. That is the crux. In the case of insolvency and bankruptcy code provisions, valuation of a company is required to be done as on the date of insolvency commencement date, the date on which NCLT admitted the case for CIRP. That is the date on which the valuation is actually required to be carried out. The actual process of carrying out valuation may happen 45 days later, maybe 2 months later, but the date which is going to be relevant for valuation purposes is going to be the insolvency commencement date. So valuation of any asset depends upon who is doing valuation, why valuation, and when the valuation is being done. So what is the typical valuation process that a valuation professional will follow once he gets an assignment? The first step is to understand the purpose of valuation. If you are empaneled with the bank is looking for providing a credit line to a business and looking for some kind of a security, either primary or collateral security from that business, may engage you for the purpose of carrying out valuation of collateral security. In the case of IBC, the interim resolution professional or the resolution professional will appoint valuers with a view to carrying out valuation of the business under CIRP. In the case of mergers and acquisition, maybe both the parties, the seller as well as buyer, because they are both interested in finding out what is the approximate economic worth of the business as of today. That's important and relevant to understand both from seller's perspective as well as buyer's perspective. So it's got to be very clear what is the purpose for which valuation is being sought and what is the objective of valuation. The next step is to collect relevant information from the company which is being valued. So you check out the financials, you look at the past data, you look at the forecasted cash flows for the future, you look at the budgets, you look at the capex plans of the company, you look at the capacity of the company, you look at all relevant information pertaining to the company, both for the past period, that is period prior to the valuation date, as well as whatever information is available in the company domain, which pertains to its future outlook. And then once you are able to lay your hands on the basic relevant information pertaining to the company, then you got to carry out some homework and do some financial analysis with a view to doing a health check of the company. And while doing the health check and analysis, you will always probably have to do some kind of normalization adjustments. If you look at the financial numbers of any company pertaining to the period 2021 or 21-22, you will find huge spikes, either on the upside or on the downside because of the impact of COVID-19 pandemic situation. But then we know that most of the businesses have since recovered from COVID-19 pandemic, and many of them are on the path of recovery. So you can't bank on those numbers of those two particular years where the severity of COVID-19 pandemic was maximum, and therefore, in order to make projections for the future, you got to carry out normalization adjustment. Then, besides looking at internal information pertaining to a particular company, you also have to look out for the macro information in terms of how the world economy is going to perform going forward in next few years, how is Indian economy going to perform, and then what are the trends prevailing in the sector or the industry to which the company belongs. If the sector is increasing, rising at a CAGR, compounded annual growth rate of 10% every year, and the company has given you projections where they are saying the company is likely to grow at a CAGR of 24%, I think you need some kind of validation of these numbers, because end of the day, the company belongs to a particular sector, a particular industry. Of course, it will not match the exact average growth rate of the industry as a whole, but still the number cannot be as widely different as 10% and 24%. And that's where you also got to check the forecast provided to you by the company management and validate these by way of your deep insights and research that you carry out. You can check out RBI data. You can check out data on a website of CMIE, Center for Monitoring Indian Economy. You can check out the data of Niti Aayog. You can check out data available on various other government as well as private portals with a view to validating the forecast for the future provided to you by the company, because that's going to be very, very crucial and critical and relevant for valuation of that business. So once we have done all the work up to stage number 5, Now you have reached a point where you got to decide which valuation approach to follow in a particular subject case. I'm going to discuss the approaches to valuation a little later, but let me just name the approaches to you right away. There are primarily three approaches to valuation: income approach, market approach, and cost approach. Which approach is going to be most relevant in the valuation of a particular business or asset? That is the call, end of the day, that valuation professional will have to take, depending upon the purpose of valuation and the kind of information that he has been able to gather, both internal from the company as well as from the external environment or the secondary information that he is in possession of. Yes, of course. He may not only go with only one approach, he may decide to apply two approaches. And obviously, if he applies income approach, he will get one estimate of valuation. If he applies cost approach, he's going to get a different estimate of valuation. And then finally, he can probably look at some kind of averaging. Maybe a simple average or maybe a weighted average to be able to arrive at the final estimate of value of a business or an asset. International valuation standards allow you to make use of one or two or maybe even all the three approaches to valuation, provided you are able to justify that in terms of the purpose and also the kind of information that was available to you for the purpose of carrying out valuation. You are free to use any or all the three approaches of value. Once you are clear now which approach you're going to follow, the last point is performing actual calculations of valuation. You may use an Excel, you may use RStudio, you may use Python, you may use some other financial mechanics, financial modeling tool where you have to actually now carry out the valuation of the business, the computation part. And then whatever number you get by way of that computation, you put that in the form of a report, providing right from the beginning what was the purpose of valuation, what are the basic information pertaining to the company or the asset which you are proposing to value, which approach you have followed and why, which other approaches you have not followed and why, and what is the final computed number. Of course, in between, you will also provide details about the assumptions that you have made while carrying out the valuation and also caveats, limitations, and disclaimers. And that will complete your final report, which you will then hand over to the client who had given you the particular assignment for carrying out valuation. In general, typically, this is the process that's followed for the purpose of carrying out valuation of a business. Let's discuss the valuation approaches in some more detail. In the income approach, we apply and we follow what is commonly known as the discounted cash flow technique. What is done is that we look at the forecasted cash flows of the business and then apply a discount rate to work out the present value equivalent of those future cash flows of the company with a view to arriving at the valuation of a business. Looks to be fairly simple, but there are two important things that you require. One is forecast of the future cash flows. Looks simple, but how do you get those actual numbers in real life? You may ask the management because they know their business better. They've been operating that business maybe for over 2, 3, 4 decades. You are an outsider. But yes, of course, an intelligent, knowledgeable outsider. But probably still it is good enough and reasonably okay for you to ask for the basic forecast of future cash flows from the management of the company. But yes, don't accept that at the face value. carry out your independent appraisal, your independent study for validation purposes, whether the forecast provided to you by the management is realistic, achievable, not achievable, whatever. You got to do a lot of homework from your side. If we are looking at the premise of a going concern business, then there is a challenge. How far ahead can you forecast the cash flows of a business? 5 years, 7 years, 10 years? Can you do it for 50 years? And nobody knows what might happen because future is so uncertain and it's a VUCA world that we are living in. It's very, very different to forecast the future cash flows or the future potential of a business beyond a particular point. But in the books on financial management, we have concepts of explicit period and period beyond the explicit period. Explicit period is the period within which probably you can make a reasonably accurate forecast of the business in future. That could be 5 years, could be 7 years, could be 10 years. But then, of course, we are saying that the business will not get into liquidation after 10 years. But I'm accepting the fact, I don't know what is going to be the likely future forecast for the business beyond 10 years. But the business will survive. I'm not saying business will get into liquidation, but unfortunately, I'm not able to figure out the forecast beyond explicit period, a certain period of time in future. So in financial management books, there are adequate number of models available. We don't have time to get into the nitty-gritties, but there are models available by which we can work out what is known as the forecasted cash flows of the business in perpetuity. You can apply your growth rate and then you can probably work out some kind of an estimate of the overall life cycle future cash flows of the company that you can work out by applying some kind of future financial modeling and models which are available in the textbooks. The second critical component while applying the DCF approach is the discount factor, which is very, very critical once again. Some projects are so sensitive that if you apply a 14% discount factor, the project may be unfeasible economically. And if you apply a 12% discount factor, the project may turn out to be feasible. Just because of the difference of 2% in the discount factor, well, the decision could be here and there. And therefore, the choice of an appropriate discount factor is very, very critical in the context of applying income approach and then using the discounted cash flow technique for arriving at the valuation of a business or any asset. So how do you look at choosing an appropriate discount factor? Well, number one, you may probably check out and look at the inflation data. What is the inflation likely to be over the next few years in Indian economy? Right now, it is hovering around 4.5%, but don't know. Next 3 years, what's going to be the inflation level? After 3 years, what's going to be the level of inflation? Well, you can check out some of the government data on RBI website, Niti Aayog, CMAs, and make a reasonably justified forecast as to what is going to be the inflation rate prevailing in the marketplace in Indian economy over the next few years. You can also check out what is your WACC, weighted average cost of capital. Essentially, a company has two different sources for obtaining funds for its business. You either have equity capital or you have debt capital. You either have internal sources of funds or external sources of funds. But each one of the sources of funds, within debt, you have very many different variations. You have bonds, you have debentures, you have preference shares, you have cumulative preference shares and things like that. And thus each source is going to have a different cost associated with it. And thus by using a common concept of weighted average cost of capital, you can work out what is that one single number which indicates the cost of funds deployed in a business. And that sort of becomes a kind of a benchmark for you to decide or take a call on the discount factor which you're going to use for evaluating the value of a particular business. The discount factor will also depend upon the riskiness of the business. Higher the risk, higher discount factor should be used for evaluation of the value of that business. Valuation is also dependent upon the kind of risk inherent underlying in a business. And thus you got to also work out what is the risk associated with a particular business. And depending upon that, the choice of discount rate will also probably will have to be adjusted appropriately. And then the last factor that's most critical and most vital is you have looked at inflation data, inflation trends. You have checked out the weighted average cost of capital. You have also looked at the risk profile of the company. End of the day, it's a judgment call. The valuation professional has to decide which is going to be an appropriate discount factor to be used in a particular instant. After looking at all that information, what he could lay his hands on in terms of inflation, in terms of risk, in terms of WACC. End of the day, it's a judgment call. Gut feeling, judgment is what will ultimately matter in determination of the discount factor. I was evaluating a project during my corporate life where I was head of the finance, and I had a young management graduate, MBA graduate working with me as my assistant. And we were looking at evaluating economic feasibility of a new project that the company was planning to put up. And we had looked at the forecasted cash flows, we had looked at inflation data, we looked at WACC, we looked at the risk profile of the project, and we had all kinds of information available. And my managing director was time and again asking me, how long will you take to do the evaluation? Please tell me what is the result, and then we'll call a board meeting and then take an approval and go ahead with the project. End of the day, after a few days, few weeks of analysis, finally I had to take a call. And I told my young assistant there, let's do it at 12.5% discount factor. He said, fine, sir. Very smart young guy who was working with me as my assistant. He did the calculations very, very fast, very nicely, and came out to be the project is economically feasible. I went to my managing director, showed him the calculation and the basic perspective, and he said, he gave me the go ahead, and he said, let's call for a board meeting and then get started with the project. I came back to my cabin. I hugely thanked my young management graduate assistant who had immensely helped me in evaluating economic feasibility of this project. And I was so happy. And so I also thanked him very, very profusely for helping me out with this economic analysis of this project. And he went out of my cabin. We all stay in office till about 6:37, 6 o'clock, whatever. 6:30, when it was time to wind up and go out of office, suddenly that young management graduate comes knocking on the door of my cabin and he says, sir, may I come in? I want to ask you one or two questions. Well, I said, why not, please? He came inside, bang, and then he asked me two questions specifically. His first question was, sir, after looking at all the kind of data that we had collected, inflation, WACC, risk, and whatnot, how did you decide to use a 12.5% discount factor? How did you arrive at that magic number? And his second question was, sir, why did you choose 12.5% discount factor? Why not 12.4% or why not 12.7%? Very, very pointed two questions that this young management graduate posed to me, which I had to answer. So my answer to the first question was appropriate discount factor choice depends upon end of the day judgment, gut feeling. We have to look at all the relevant information and data, whatever is available at a given point of time. But end of the day, it's a judgment call because we really don't know how the economy, how the economic variables are going to perform, change in future period of time. So we have all worked in corporates for a long period. Some of us have gray hairs. We have seen many projects. We have done evaluation of many projects. Many of our projects were successful. We had done the economic feasibility right. In one or two cases, our decision was wrong, turned out to be wrong later. So in my view, you don't win or you don't lose. It's not either you win or you lose. It is either you win or you learn. So I've learned a lot from my corporate failures where my decision did not turn out to be the right decision. In some of the cases, I've learned from that. And based upon that understanding and judgment, I thought that probably 12.5% is going to be the appropriate discount factor in this particular case. And my answer to the second question, why 12.5%? Why not 12.4? Why not 12.7? My simple answer was, as human beings, we are more comfortable dealing with round numbers. It would not have made much of a difference if I'd used 12.4% or 12.7%. But normally, जब आप बात करते हैं कौन सा factor आपको use करना है, normally you tend to go with round numbers kind of thing. And that's how I straight away said, let's do it at 12.5%. There was no other reason. I think even at 12.4 or 12.7, the project would still have been economically feasible. So that's the critical aspect of looking at the DCF approach. You got to do an appropriate forecasting of future cash flows. At the same time, you also got to look at appropriate discount factor to be used in a particular case. Otherwise, your results may go haywire and you may not be able to come out with the appropriate valuation of a given business in such case. The next approach that we look at in valuation is the market approach, where you check out that besides this company that I'm looking at, there are going to be number of other businesses existing in the same industry. How are they performing? They're performing in the sense of what is their stock price? Or if any merger acquisition transaction has taken place in that particular industry vertical over a period of last few months or so, or maybe even few weeks, that might give you some kind of an idea, some kind of a cue as to what are the kind of valuations going in that particular sector. So market approach is where you look at comparables. You look at comparable companies. Yes, of course. No two businesses are going to be replicate of one another. Even if you talk about a cement company with same capacity levels, whatever, still there's going to be difference in the two companies' operation because of technology, management, number of workers, location, many factors for that matter. But once you know that you have a peer company having almost comparable capacity, turnover size, and the valuation of that company is X number, and then you can start comparing your company with that company and then increase by 5%, decrease by 7%, increase by 10%, certain factors, and you'll be able to work out the valuation of the given company by looking at the comparable peer company existing in the same industry. And then you have the cost approach, which is also called the asset-based approach, which is normally used in the case of liquidation. Because you know nothing is left out in the business, it's difficult to survive for the company in the marketplace as a going concern. For any foreseeable future, you're only looking at liquidation, selling out the assets of the company, realizing cash. And if you're looking at IBC kind of situation, applying waterfall mechanism, Section 53 of IBC, deciding the priorities and paying out all your liabilities and be done away with. The cost approach is also similar to looking at replacement value. What will be the cost of replacing this business today? The example which I've given you, that someone is looking for buying a ready-made house, how much price would he be willing to pay for that? That's also going to depend upon for how much cost the same kind of house, same design, same location, same size can be constructed today. I mean, it may not be an absolutely accurate number, but Architects and engineers can definitely provide you some kind of a reasonably approximate estimate, which will give you a fairly good idea as to what is the replacement cost of this asset at a given point of time for that matter. So what are the professional opportunities in the valuation domain? We have basically understood in broad perspectives what valuation is all about. What are the factors which determine the valuation of any business or any asset? What are the different approaches to valuation one has to choose from while arriving at the estimate of value of a business or an asset? And thus it looks to be quite a lucrative and a promising professional avenue for all of us. I would now like to share with you specific information as to what are the professional opportunities available in the valuation domain, which all of us can explore and take advantage of the same. The first aspect is valuation under IBC, Insolvency and Bankruptcy Code. Section 247 of the Companies Act 2013 talks about the whole concept of registered valuer. And it goes on to say that all valuations which are required under the Companies Act 2013 and under Insolvency and Bankruptcy Code 2016 can only be done by people who are registered valuers. How do you become a registered valuer? I'll come to that a little later. I'm going to give you proper guidance for that as well. But as of now, as per the rules, the Companies Act Section 247, all valuations required to be carried out under the Companies Act and under IBC can only be performed by registered valuers. As of now, any valuation required by a bank, by SEBI, under FEMA, under income tax, under wealth tax, under CCI, can be done by a non-registered valuer, can be done by any professional available in the marketplace. As of now, it's mandatory only for Companies Act valuations and IBC that it can only be done and performed by a registered valuer. As per the provisions of IBC, when a company gets into CIRP, after its admittance by NCLT, two registered valuers are required to be appointed by the resolution professional for each of the three asset classes. And there are three different asset classes identified for that purpose. We have securities of financial assets, land and building, plant and machinery, and you got to appoint two registered valuers for carrying out valuation of assets under each of these asset classes, and each valuer is required to provide an estimate of a fair value and a liquidation value. Fair value, which is going to be based on the premise of going concern, and liquidation value based on the premise of liquidation of the company not being able to survive in the market as a going concern going forward. They are required to provide these two estimates, the fair value and the liquidation value. And in case the values provided by the two valuers vary significantly, and what is significant? If the variance between the valuations given by two valuers exceeds 25%, then a third valuer is required to be appointed to give his opinion with regard to estimate of the value. But then it doesn't solve the problem. It actually complicates and compounds the problem further, because the third valuer then is going to come out with a different estimate. Remember my earlier slide where I said, value lies in the eyes of the beholder. Valuation differs from person to person. If there are three persons carrying out valuation, their estimate of value is going to be different. But then end of the day, we take an average and then try and sort out the whole issue. But that's the requirement of appointment of a registered valuer for provision of IBC cases where valuation is required to be carried out. Under the Companies Act, valuation is required for very many different purposes. Issue of shares for consideration other than cash, or in case the company is going to issue sweat equity or ESOPs to the employees, issue of shares on right basis, non-cash transactions with the directors, Compromise arrangement, mergers, acquisitions, takeover, all these require valuations to be carried out, which again can be done only by a person who is a registered valuer pursuant to Section 247 of the Companies Act 2013. When you're looking for acquiring minority shareholding, or when you're valuing assets of the company at the time of its winding up, or when you're giving declaration of solvency at the time of voluntary winding up of the company, again, valuation will be required, and that will be conducted only by a registered value. Under SEBI regulations, you're required to carry out valuation for a number of purposes. Periodic disclosures, you got to work out NAV, shares that are not frequently traded, direct acquisition under the Takeover Code Regulation 2015, conversion of debt into equity under SDR, Strategic Debt Restructuring Scheme, or issue of shares on preferential basis. I'm sure you all are clear about that. There is a difference between preference shares and issue of shares on a preferential basis. In the latter case, these are equity shares only. They are not preference shares, but these are proposed to be issued to a certain identified segment of investors. Maybe not even investors, stakeholders. Could be your own employees, could be your directors, could be a joint venture partner, could be a foreign collaborator, whatever. You are also required to work out fair value of delisted equity shares. And at times, you're also required to carry out valuation of intangible assets, brand, patents, copyright, trademark, software, intellectual property under SEBI regulations. And that's where the importance of valuation comes, even within various regulations and guidelines of SEBI. Coming to Indian accounting standards, there are situations where valuation is required to be carried out. That's where revaluation is to be done of property, plant, and equipment. Or you got to work out fair value of unlisted investments, fair value for impairment testing purposes, valuation required for business combinations, valuation of non-current assets held for disposal, not held for operations of the company, but held for disposal. Similarly, how do you value leases? How do you value government grants? All these are requirements under Ind AS where valuation again is required to be carried out. FEMA, inbound foreign investment by an unlisted entity, buyback of shares by an Indian entity from foreign shareholders, transactions involving swap shares between companies involving foreign shareholders, transfer of shares in unlisted Indian companies between a resident and a non-resident, or vice versa. Transfer or disposal of shares in foreign entities by a resident. All these situations require valuation to be carried out, and thus there is huge scope and opportunities for the valuation professions in the marketplace under all these various laws. Income tax, purchase and sale of shares in case of an unlisted company, issue of shares by a company where public is not substantially interested, valuation in case of sweat equity shares, slump sale, valuation as a perquisite value for ESOPs. These are the requirements and situations where valuation is required to be done under income tax act. So there is huge professional activity potential for registered valuers in the marketplace. There are about 21 lakh companies which are registered with various registrars of companies within India. Almost about 5 lakhs of them are not active. The number of active companies are almost around approximately 15 lakhs. And Indian economy is the fifth largest economy of the world. And we are aiming and eyeing to become the third largest economy of the world within the next few years. And thus, the corporate actions are going to be on the rise. Corporate actions means mergers, acquisition, issue of sweat equity shares, right shares, bonus shares, preferential shares, ESOPs, All these activities are going to be on the rise. And all this is going to provide lot of new opportunities for the valuation professionals in the Indian ecosystem. And mind you, there are also going to be, in addition, large number of cases getting filed under IBC, and thus the requirement of valuation professionals. Large number of startups which are already mushrooming in India and making India the third largest hub of the startups across the world. And we are also now going forward looking at valuation of different types of capital, not only financial capital, but in the changing phase of corporate reporting, we are now looking and talking about different kinds of capital: human capital, relational capital, intellectual capital, social capital, and then tea and coffee plantation, rubber plantation. These are emerging new areas where valuation is going to open up lots of new opportunities for all of us. So this is what I discussed in brief, that Section 247 provides for a new concept of registered valuer. And we have also a draft valuation bill floated by the government. We are yet to see the final word from the government on that. But nonetheless, the government is looking at institutionalizing the whole valuation ecosystem within the country. So who can become a registered valuer? A cost accountant, chartered accountant, company secretary with a minimum of 3 years experience, a postgraduate in 3 years experience, graduate with a 5 years experience, and the qualification, the experience requirements are all mentioned in the guidelines of eligibility for qualification and experience. These are available on our website, ICMAI RBO, also available on the website of IBBI and various other government portals. You have to first undergo a mandatory 50 hours educational course being organized by various RBOs, including ICMAI Registered Valuers Organization, which is a mandatory requirement, and the entire syllabus prescribed by IBBI is required to be covered within those mandated 50 hours. And once you complete the 50 hours mandatory course, then you become eligible for appearing for the exam conducted by IBBI. In fact, it is actually conducted by NISM. The fee is 5,000 rupees plus GST for each attempt. And the gap between one attempt and the other attempt, the time period now has been reduced to 21 days. It's no longer two months here, it is 21 days. If you appear for an exam, not able to qualify for whatever reason, after 21 days, again, you can make an attempt and possibly get through the valuation examination. And once you clear this exam, you'll be enrolled by the particular RVO as a member, and also you'll be issued a certificate of registered valuer by IBBI, and then you become a full-fledged professional registered valuer. So to summarize and close up my session, valuation is the pivot around which all economic and financial decisions are made. Very, very important. But another important point to note is that valuation is not only about numbers. If someone says, give me the financial statement for the last 5 years, give me the financial estimates forecast for the next 5 years, I'm expert in Excel, RStudio, Python, I'll give you valuation within 3 hours. I don't think valuation is all about numbers. Numbers are the starting point, yes. But then using those numbers, looking at those numbers, you have to weave a complete story around those numbers. And that's the reason why even the companies which are bleeding financially as of today, especially the startups, have nonetheless a very high valuation, because valuation is not only about numbers. It's all about the capability of the business to be able to create value, preserve value, and enhance that value going forward on a sustainable basis. It's not only about numbers. There are lots of assumptions. You got to decide the premise. It's a matter of judgment, gut feeling, hunch. Everything counts when you are looking at arriving at the estimate of value of any business. And valuation goes beyond financial capital. You got to check out what is the quality of human resources of the company. What is the intellectual capital that the company has in terms of brand, patents, trademark, whatnot? And thus, valuation ultimately is a comprehensive estimate of the economic benefits that someone can expect to derive by acquiring a business today by looking at various different dimensions of capital, not only limiting estimate of value to financial capital. Remember, price is what you pay, value is what you get. Value lies in the eyes of the beholder. Whether valuation is an art or a science, it is both. There are certain universally accepted principles of valuation which are applied all across the world, all types of business valuation assignments, but the way you apply them is an art. But more than valuation being an art or a science, to my mind, it is actually more of a craft. By looking at some of the information about the company, you try to craft an estimate of the value of a business. So it's more like a craft. And always remember, valuations are temporary, values are permanent. The valuation of a business may go up and down depending upon the phase of the business cycle or a lot of other activity and events happening in the business and economic environment. End of the day, what creates value for the business, end of the day, and what matters is your values, ethics. Valuations are temporary, values are permanent. Thank you so much. But once again, don't forget that valuation is an art and a science, but more of a craft because it requires a lot of judgment. It requires a lot of gut feeling with a view to arriving at the final estimate of value for business by looking at all the available relevant data. Thank you so much for joining in for this particular web session. I'll be pleased to answer a few views, queries, questions, if any one of the participants may have at this point of time. Over to you, please. Any questions? Any
Sir, basically, CMS and I mean to say all the professional qualified like CMS, CAS, they can do only the financial valuations, on securities
Absolutely, sir.
valuation. Right?
Absolutely, sir.
So that
Absolutely.
is one thing. And
Absolutely.
see, if anybody has got like CMA who has got COP, and then he can go ahead and then write this, I mean to say, take the training of 50 hours, and then he can become once the exam is qualified, he can become a registered valuer.
Absolutely, sir. Absolutely, sir. There are
Okay.
few people in the marketplace who are engineers and CMAs. There's some,
Huh.
we are all aware about that. Then those people qualify for both the categories. I mean, they can also probably become valuer for land building or plant machinery, and they also are eligible to become a registered valuer for the security of financial assets class. So it depends upon the kind of qualification you have. You got to check out your eligibility as per the guidelines prescribed by IBBI and then take a call which particular asset class you are entitled to, eligible to become a registered valuer.
The 50 hours training, whatever is being given by our institute, I'm a
Yes,
CMA, sir, basically. So
yes,
our institute is also into this RVO
yes, sir.
enrolled. So this 50 hour training is a ever going process or
Well, we
continuous
conduct
process, or how
one
does it
month.
happen? It is a
We
periodic.
conduct a program almost with a gap of about 3 weeks, 21, 25 days gap, and then we have a program going on. Every
Oh,
month we
that's
conduct one program for sure.
every month
But
you start a program.
yeah, every month. But over a period of 12 months, we will conduct about 16 programs or so. So the frequency is less than a month, but yes, in a month, we'll conduct generally one program. You can check out our website, rvoicmai.in, and check out the details of the next program when it is going to start or going to operate.
Oh,
Thank you,
okay.
sir.
Okay. So this PPT and all, can you share it, sir, if you
Sure,
don't
sir.
mind?
I'll share the PPT with all the participants through the coordinator of this program.
Okay. Because yesterday also I
No,
attended for
I'll
social
share
audit.
the yesterday's
On that,
presentation also. That also I'll organize, sir, for all of you.
yeah, please, sir, please. That was very insightful. In
Thank
fact,
you
it's
so much.
really
Thank you
helping
so
us a
much
lot.
for joining, sir. Yeah, 5,000 rupees for each attempt in the fee, sir, as per the prescribed guidelines of IBBI. And that is the requirement as of now. Thank you so much. Good evening. Namaskar.
Sir, this
I have one question.
Yes, please. Yes.
Hello.
Yes, please.
Sir, that 3 years requirement for CA is in practice, or those who have qualified, they can also appear for the exam
No, you
after
need to
three
have
years.
a COP, sir. You need to have a COP.
No, what I'm asking is that if after COP 3 years is not there, but after qualification 3 years is completed, so they are eligible.
No, you need to have 3 years experience after COP, sir.
Okay, 3 years should be after COP.
Yes, please. Yes,
And
please.
one more question, sir. If somebody is cleared PG postgraduate in commerce and 3 years is completed, so will they be eligible for appearing or
3 years
taking registration?
after post-graduation in commerce, 3 years experience is required, sir.
Okay, post graduation in commerce plus 3 years experience is eligible.
Yes, please. You are eligible to
Even though
get.
if they are in less than practice for 3 years, that will do.
I know. If you're a postgraduate with a 3 years experience, that will do. Even if your COB experience is falling short, you can take the advantage of that second qualification that you have, and you can.
Okay, okay, that is eligible. Okay, like
Yes.
that it is eligible.
Thank you. Thank you.
Okay, thank you, sir. Yeah, thank you very much.
Sir, this concept of valuation
Ji.
has, I will say this, globally we are seeing everywhere the new business starters, they want to get rid of or sell the business within 5 years, 10 years. Earlier, the trend was that the people, this business were for generations together. Now, why this change in trend?
So it is basically creating value for the stakeholders, including promoters. So, the corollary to this is that some of us who are kind of 60 plus, 55 plus, or whatever, in our times, the limited job opportunities were there. We used to join a particular job, and probably over the entire lifetime, we will change maybe just one or two or three jobs over a period of 40 years. But now look at the trend, how youngsters are job hopping every 3 years, every 4 years for that matter. It's a trend which is fast catching up in the marketplace. And similarly for the startups also, they create a startup, they ramp up its value, and then they cash it out. I mean, they make money out of it. They create value for the promoters and the stakeholders, and they sell it out and then move on to building up some other venture for that matter. It's a global trend which is fast catching up. That's why
So
I
one
said in my first slide itself, the world is changing, and it is
Yeah, yeah.
changing very, very rapidly and significantly.
Or I think it is we can say it is a good sign also, because we are seeing many new things also
It is
because
like,
of
sir,
this.
we can't really say good sign because it is like answering or trying to answer a question. Are we happier than our forefathers?
Yeah,
I
yeah,
don't know.
yeah, yeah,
Because
yeah.
those
That
times
yes,
were
yes,
different. If you were
yes,
to compare your life of 1980, 1990 with today, there's
yes.
no comparison. Those
No
times were
comparison.
different.
Yes,
So
yes,
we can't really say, are we happier than our forefathers or not?
yes.
मुश्किल होगा बताना.
Mushkil.
sir, one
Thank you,
one
sir.
request. The RVs are not entitled to go for the income tax valuation. So kindly look into this
Oh,
matter.
sure, sir. Sure, sir. No, we are working on that direction with the government, with MCA, trying to make it mandatory for all authorities, the banks, income tax,
Particularly,
CB,
sir, I am
FEMA, for
facing in
employment
Eastern
of
region.
gifted valuers. Yeah.
Sir, particularly I am facing in Eastern region. They are not interested for the empanelment of the registered valuer
Okay.
as they are empaneled area.
No, we are jointly working in that direction, sir.
Sure,
It may
sure,
take some
sure.
time, but it's definitely going to happen.
And another request is that region base of this type of webinar or direct physical conference is very much required. They
Sure,
should
sir. Sure,
know
sir. Sure,
very
sir.
good area of
Absolutely.
operation,
Yeah, yeah.
including sir capital market. This is also our area. They can also, the cost accountant also can do this capital area market, as well also the FEMA audit. It is very much applicable for the cost accountants.
Sure, sir. We'll organize these programs region wise also in
Yeah,
physical
sir.
mode. We'll plan out our schedule and reach out to each one of you, and we'll organize these programs at regional level also in physical mode, sir.
ठीक
Thank you.
सर, ठीक सर, थैंक यू सर.
सर कंपनी एक्ट में राइट शेयर्स का वैल्यूएशन भी नहीं करवाते हैं लोग, रजिस्टर्ड वैल्यूएशन.
You